Welcome to the Deep Dive. Today we're taking a deep dive into something that touches every single one of our lives, whether we want it to or not. Money. But we're not just crunching numbers or talking markets in the usual way. We're exploring the psychology of it all, pulling key insights from the fascinating book, The Psychology of Money.
Yeah, and our mission with this deep dive is really to unpack why we behave the way we do when it comes to our finances. We want to highlight some, surprising facts the book reveals.
Right.
And most importantly, figure out what that means for you and your own relationship with money.
And right off the bat, one of the most powerful ideas the book presents is that financial success often boils down less to how smart you are or how much formal education you have, and surprisingly, much more to your behavior. And there's a story that just perfectly illustrates this.
Oh, the Ronald Read story. It's incredible. Imagine this guy from rural Vermont, a janitor and a gas station attendant.
Yeah.
He was the first person in his family to finish high school, apparently even hitchhiking to campus every day.
Wow.
Lived a remarkably low-key life. Bought a modest two-bedroom house for like $12,000 when he was 38.
Wow.
Lived there his whole life, widowed in his 50s, never remarried. His main hobby, chopping firewood.
Just a really simple, quiet existence. But when Red died in 2014, aged 92, his passing made international news.
Right.
And the surprise, he was one of fewer than 4,000 Americans who died that year with a net worth over $8 million.
$8 million?
Yeah. He left millions to his local hospital and library. People who knew him were just completely baffled. How did he do it?
And there was no lottery win, right?
Yeah.
No secret inheritance. The secret was incredibly simple. He saved what little he could. He invested it in solid, well-known companies, blue-chip stocks, and then he just waited.
For decades.
Yeah, for decades.
Yeah.
Patiently, consistently.
That simple, almost boring act of saving and waiting for decades. It's such a contrast to the other side of the coin the book mentions. You know, a brilliant person who can be a total financial disaster if they lose control of their emotions.
Exactly. It really highlights that ordinary folks, people without fancy degrees or high incomes, can build significant wealth with just a few key behavioral skills.
And this is really the central argument running through the book, isn't it?
It absolutely is. Unlike something like, say, health, where science can give us pretty clear rules for how the human body works, money is different.
How so?
Well, it's guided by people's behaviors, and those behaviors can look completely irrational, maybe even crazy to someone else,
right,
because they're based on completely different life experiences. Trying to understand why someone might take on massive debt or sell everything during a market low, it requires looking beyond the finance equations.
You need to look at the human stuff.
Exactly. History, greed, insecurity, optimism, all that messy human stuff, not just finance or math.
Voltaire famously said, "History never repeats itself. Man always does." And that seems to apply perfectly here.
It really does.
Yeah.
It's less about complex math and more about, predictable human reactions.
Which brings us to another crucial point the book makes: the power of personal experience.
Yes, this is huge. The book makes this striking point that your own individual history with money, which is maybe, 0.000000001% of the world's total financial history, tiny fraction.
Practically nothing in the grand scheme.
Right. But that tiny sliver probably makes up about 80% of how you think the financial world actually works.
Okay, let's unpack that. So this is why equally smart people can look at the same investment, the same data, and come to completely different conclusions about risk or what's important.
Precisely. Your personal journey shapes your financial worldview way more than you might realize. The book gives examples like John F. Kennedy.
Okay.
He admitted he had no firsthand knowledge of the Great Depression because his family was wealthy. That's a vastly different experience than millions of others had.
Or think about how your view of the stock market might change depending on when you were born.
Oh, absolutely. If you were born around 1970, you saw the S&P 500 just explode upwards during your teens and 20s almost tenfold, adjusted for inflation.
Incredible growth.
But if you were born, say, around 1950, the market basically went nowhere, inflation adjusted, during those same formative years.
Wow. Two completely different, deeply ingrained experiences.
And the same thing applies to inflation. If you grew up in the 1960s, you saw prices more than triple. You felt that sting of rising costs constantly.
Right.
Someone born in the 1990s, they've experienced incredibly low inflation their entire life. It's probably never been a major financial worry for them.
So these vastly different realities just hardwired different beliefs about how the economy functions.
Exactly. And this is where the book's idea that no one is crazy really hits home. It shares this powerful example from a New York Times story about working conditions at Foxconn in China.
Ah, yes, I remember reading about that. Americans saw sweatshops and were understandably outraged.
Right. But then there was this comment from the nephew of a Chinese worker.
Yeah.
And it offered this profoundly different perspective. His aunt had worked there. Hard work, long hours, low pay, bad conditions, all that.
Yeah.
But before that job, she was a prostitute.
Wow. That's intense.
And his point was that being exploited by an evil capitalist boss for a couple of dollars, as he put it, was actually a huge improvement over having her body exploited by several men for pennies.
Gosh.
So from their incredibly difficult reality, the factory job wasn't exploitation, it was an improvement. It was even a dream compared to her old life. He said something like, "We are paying for a dream, and you may not understand that because you were already living a dream."
That's heartbreaking, but crystal clear. It powerfully illustrates that people make financial decisions that seem perfectly rational to them based on their unique, often very difficult, personal histories.
Exactly. What looks crazy to you might be a massive step up for someone else based on the world they actually live in. Nobody's crazy. We're all just responding to the hand life dealt us and the experiences that shaped us.
Building on that uncertainty and different perspectives, the book then dives into the roles of luck and risk.
Yes, the inseparable siblings, as the book calls them. They play this massive part in financial outcomes. And, it's hard to measure luck, and it can be awkward sometimes to talk about its role in success.
Right. People like to think it was all skill.
Of course, but luck is definitely there. Robert Shiller, the Nobel laureate, apparently said the one thing he'd most want to know about investing that we can't know is the exact role of luck in successful outcomes.
That says a lot.
It does. And because luck and risk are always involved, judging financial success and failure gets really tricky. Things are rarely as good or as bad as they seem on the surface.
Because those external factors are always playing a part.
Right. Failure isn't always about laziness or bad decisions.
Yeah.
Sometimes it's just ending up on the wrong side of risk, even if you did everything right.
And here's where it gets really interesting, I think. The book highlights this difference between people who are great at getting wealthy versus those who are good at staying wealthy.
Yes. Using the stories of Rajat Gupta and Jesse Livermore.
Gupta, the former Goldman Sachs board member, and Livermore, the legendary stock trader.
Both were absolute masters at making huge sums of money. Gupta had, a 9-figure net worth? Livermore made the equivalent of billions today in single trading days. They were brilliant at the getting rich part.
But terrible at staying rich.
Exactly. Gupta ended up in prison for insider trading because he just had to have more chasing that billionaire status.
Risking what he had and needed for something he didn't have and didn't need.
Precisely. And Livermore, despite his massive wins, kept taking enormous risks, often using leverage. He lost everything multiple times and, tragically, took his own life in the end.
So the lesson is, what? How do you stay wealthy?
Well, the book argues there's really only one reliable way. It's a combination of frugality and a healthy dose of paranoia, basically survival.
Survival. Not optimizing for the absolute highest return, but just making sure you stay in the game.
That's the core. The book tells that story about Warren Buffett, Charlie Munger, and another investor named Rick, who was apparently just as smart as they were.
Okay.
Rick was incredibly good at getting rich quick, but in Buffett's words, he was in a hurry. So during that brutal market crash in 73, 74, stocks fell like 70%.
Ouch.
Rick was using margin loans, borrowed money to invest, amplifying his risk. When the market plunged, he got margin calls. His broker demanded more cash, or he had to sell.
At the worst possible time.
Exactly. He was forced to sell his shares right at the bottom, including shares he sold to Buffett for less than $40. He got wiped out because the leverage meant he couldn't survive that temporary, albeit severe downturn.
Whereas Buffett and Munger,
they weren't in a hurry. They didn't use that kind of ruinous leverage. They survived. They stayed in the game.
So getting money requires taking risks, being optimistic.
Yep. But keeping money requires almost the opposite skills. Humility, a realistic fear that things can go wrong, frugality, accepting that luck probably played a part. Survival is the most crucial skill because it lets compounding do its thing.
Compounding. This is where things get really powerful, but as the book points out, it's incredibly non-intuitive for us.
Totally. Compounding is just growth building on previous growth, right?
Yeah.
Leading to exponential results. But our brains, they're wired for linear thinking.
Yeah, like the example in the book. If I ask you to calculate 8 plus 8, 8 times.
Easy, 54.
Right. But if I ask for 8 times 8, 8 times 8 to the power of 8.
Yeah, my brain just stalls. It's over 16 million, apparently. Linear thinking is simple. Exponential thinking is really hard for us.
The real world example with IBM hard drives shows it too.
Oh, yeah. From 1950 to 1990, they increased storage by about 296 megabytes. Sounds like a lot over 40 years. But from 1990 to 2019, over 100 million megabytes. 100 terabytes. The truly massive gains came in the later decades, even though the rate of improvement might have been high earlier too. That's compounding.
And because it feels counterintuitive, we often ignore its potential.
Exactly. We focus on other things, maybe less effective ways to get results. We look for quick wins or trying to time things perfectly rather than harnessing that slow, steady power of exponential growth over time.
And this loops right back to survival, doesn't it?
It does. The biggest rewards from compounding often come from simply being invested for the longest possible time, especially enduring the rough patches, the inevitable chaos and volatility. Survival ensures you're still around when that exponential curve really starts to take off.
Okay, moving on slightly, the book makes a really critical distinction that I think can fundamentally change how you look at money. The difference between being rich and being wealthy.
Yes, this is such a key insight.
Wait, I thought they were basically the same thing, or at least you had to be rich to become wealthy.
Well, most people think that way because society tends to equate money with spending money. Being rich is usually tied to your current income or, visible displays of money. Someone driving $1 million car, they probably have a high income right now. They look rich.
Okay, so wealthy is?
Wealth, as the book defines it, is the financial assets you haven't converted into visible stuff. It's the money you don't spend.
Huh.
It's the savings, the investments, the retirement accounts. It's the fancy car you didn't buy, the diamonds you didn't purchase.
So wealth is essentially what you don't see. That's a completely different way of thinking about it.
It really is. And the paradox is that what most people deep down really want is wealth. They want the freedom, the flexibility, the option that come from having assets that give them control over their time.
But our culture bombards us with images of richness.
Exactly. High income, visible spending. So we often end up chasing that instead of building true, unseen wealth.
This leads directly to a really strong case for saving money, doesn't it? The book uses that analogy about the oil crisis.
Right. We didn't just find more oil. A huge part of the solution was becoming vastly more energy efficient. The U.S. uses something like 60% less energy per dollar of GDP today than in 1950. Efficiency was key.
So applying that to money.
Focusing only on investment returns is like trying to find more oil. It's uncertain, largely outside your control. But focusing on saving and frugality, that's like becoming more energy efficient. It's much more within your control, and it has a 100% chance of working.
That's a great point. Instead of agonizing over squeezing out an extra fraction of a percent return, which is hard.
And uncertain.
Yeah, uncertain. I can just cut back on a few things, increase my savings rate by a whole percentage point, and that's guaranteed to boost my wealth building.
Exactly. The book calls this the leverage of saving. A high savings rate means lower expenses, and lower expenses mean your savings go further, buying you more flexibility faster. It can actually be more impactful than solely focusing on returns.
But it's not just about the numbers, is it? What are the sort of intangible benefits of saving?
This is where the book really digs deep, I think. Saving money without a specific spending goal attached gives you these priceless benefits. Options, flexibility, and control over your time.
Control over time, that seems key.
It's huge.
Yeah.
Savings buys you time to think, time to change your mind if you want, time to wait out uncertainty, time to grab unexpected opportunities. It's the ultimate buffer against life's inevitable surprises.
The author shares his own story, right? About investment banking.
Yeah, a brief internship, incredibly high pay, but absolutely zero control over his time. He found it soul-crushing.
And he contrasts that with a musician friend.
Right, a friend who saved just $12,000 early on, used it to quit his minimum wage job and pursue music full-time. The musician apparently said that $12K, which bought him freedom and control, was a bigger deal to him than any wealth he might get later from selling companies.
That freedom, that control, it connects directly back to happiness, doesn't it? The book mentions that even though we're much wealthier as a nation now than in the 1950s, Americans report higher rates of worry and stress.
Yeah, it's a striking paradox. We've used the increased wealth to buy bigger houses, more cars, fancier stuff, but often we've sacrificed control over our own time in the process. And studies consistently show that control over your time is a major driver of happiness and life satisfaction.
It's a powerful trade-off many people make, maybe without even realizing it. Optimizing for stuff versus optimizing for control over your schedule.
Yeah. Something to think about.
Okay, building on this idea that life is uncertain and things go wrong, the book really emphasizes the need for room for error, a margin of safety.
Absolutely critical, because the world runs on probabilities, on odds, not on certainties. Even if you're incredibly skilled, like a card counter in blackjack,
Yeah.
you can tilt the odds in your favor, sure. But you can never predict the very next card with certainty. You always need room for the unexpected, room to be wrong.
Benjamin Graham, Buffett's mentor, had that great quote, "The purpose of the margin of safety is to render the forecast unnecessary."
Exactly. You don't need to be precisely right about the future if you've built in enough buffer to handle being wrong.
And margin of safety isn't just being conservative or timid.
Not at all. It's what gives you the endurance. It allows you to withstand a wide range of outcomes, including the bad ones, and just stick around long enough for things like compounding or those positive tail events, those rare but highly impactful good things to potentially work in your favor.
The book contrasts this with strategies that might be mathematically rational, but are totally unreasonable in the real world, like that Yale study.
Oh, right. Suggesting young investors use 2-to-1 leverage, borrowing twice what they have to invest. Mathematically, over the very long run, the higher expected returns might outweigh the risk. But it meant they'd be completely wiped out if the market dropped 50%.
Which happens.
Which definitely happens. The book calls it almost absurdly unreasonable, because no normal human could emotionally handle watching 100% of their life savings just vanish and then just shrug and stick with the plan.
The mental cost would be immense.
Totally. The stress, the regret. It's huge. Room for error isn't just protecting your financial capital, it's protecting your mental capital too, so you can stay sane and keep going.
And leverage, in this context, is portrayed as, well, almost evil.
The devil, yeah.
Yeah.
It takes routine, manageable financial risks and transforms them into potentially ruinous ones. Being rationally optimistic that things will usually go right makes us underestimate the small but devastating chance of complete ruin some of the time.
And you just can't plan for every possible disaster, can you? The book gives some wild examples.
Yeah, like German tanks in World War II being disabled because mice ate the insulation on their wiring.
Seriously, mice?
Apparently. Or venture capital portfolio companies facing unexpected ruin from things completely outside the business plan, like floods, burglaries, the CEO having a breakdown, even a health department shutting down a store because a customer brought a dog inside.
Those aren't things you'd find in anyone's risk matrix.
Exactly. You can't possibly envision every specific threat. So the lesson is, avoid single points of failure. Assume that anything that can break eventually will break, even if you don't know how or when. Room for error is your buffer against that fundamental unknowability.
Speaking of not being able to predict things, the book explores something called the end of history illusion.
Right. It's this idea that we're generally pretty bad at forecasting who we will be in the future.
We think the person we are right now is basically the final version.
Kind of, yeah. We tend to massively underestimate how much our values, desires, and goals will change over time.
And that has huge implications for financial planning, right?
Absolutely. It's really hard to stick to a rigid, long-term plan for careers, for investments, even saving for specific goals when you're going to evolve significantly over decades. The odds of picking a career at 18 that you'll still love at 60 are, well, pretty low for most people.
We talked about Ronald Reed and Warren Buffett sticking to the same thing for decades, which was key to their compounding.
Yeah, but they're outliers. Most people don't want that kind of static life, or can't maintain it.
So the takeaway isn't necessarily to try and be like them.
Not necessarily. It's more about accepting the reality that you will change your mind. Don't feel trapped by decisions you made years ago based on who you were back then.
Be willing to adapt.
Exactly. The book mentions Daniel Kahneman's approach. When new information comes along, be willing to essentially detonate your previous conclusions and start over. The quicker you accept that you've changed, or maybe that you were wrong, the sooner you can adjust to move forward effectively.
And this applies to investment strategies too, presumably, if something you chose years ago doesn't fit anymore.
Absolutely. If it no longer fits your evolving goals, your risk tolerance, your life situation, it's okay to change. Plan for the reality that you will change, just like the world around you will.
Okay, we've covered a ton of ground here. Janitors, billionaires, compounding, comfort zones. But the book also points out something really fundamental. Everything in life, including financial success, has a price. And that price isn't always obvious dollars and cents.
No, exactly. The price of investing, especially in things like stocks, isn't just the money you initially put in. The real price you pay along the way is the volatility, the fear, the doubt, the uncertainty, the occasional regret you feel when things get rocky. Those are the emotional costs.
And people naturally try to avoid paying that price, don't they? They try to get the reward without the discomfort.
Yes, trying to get something for nothing. They attempt to avoid the price of volatility by timing the market, selling before a crash, buying just before a boom.
Trying to skip the fee, basically.
Right. But the cruel irony, as the book points out, is that by trying to avoid that price, they often end up paying double.
How so?
They sell low in a panic, buy high when things feel safe again. They miss the biggest up days, which often happen right after the biggest down days. Data consistently shows that average investors underperform the very funds they invest in, largely because of this emotionally driven buying and selling. They pay the price in whipsaw losses and missed gains instead of just enduring the volatility.
So the key is to reframe it. View volatility not as a fine, something bad to be avoided,
but as a fee. That's the great analogy the book uses. Think of buying a ticket to Disneyland. It costs, $100, maybe more now?
Yeah, probably.
But you see that as a fee for an experience. You want a fun day, the rides, the magic. You willingly pay that fee.
Right.
But if you saw that $100 as a fine, like a punishment, you'd never go and you'd miss out entirely.
So market returns aren't free. Volatility and uncertainty are the admission fees you have to pay for the potential of getting those higher long-term returns.
Precisely. You're not forced to pay it. You can choose safer assets like cash or bonds, which have much lower fees in terms of volatility, but also much lower potential returns over time. But if you want the potential magic of long-term market growth, you have to view the bumps along the way as a fee, a cost of admission you willingly pay to stay in the game, figure out the price, and then be willing to pay it.
Okay, speaking of different goals and approaches, the book highlights another common pitfall. Taking cues from people who are playing a completely different financial game than you are.
Oh, this happens constantly. The book argues that assets don't really have one single rational price because investors themselves have incredibly diverse goals and time horizons.
Meaning where?
Well, the right price for a share of, say, Google stock is going to be totally different for someone investing for retirement 30 years from now.
Long-term investor.
Right. Versus a day trader who's just hoping to make a profit before lunchtime.
Totally different games.
Exactly. And this helps explain bubbles, doesn't it? It's not necessarily just mass irrationality kicking in.
So what is it then?
Often is people rationally responding to changing incentives and shifting towards a short-term trading game to capture momentum. During the dot-com bubble, for example, lots of people buying Yahoo stock in 1999 weren't thinking about its earnings potential decades out. No. They were buying because they reasonably expected the price to keep going up over the next few months. They were playing a short-term momentum game. And within the rules of that game, their actions kind of made sense.
Okay. But the problem arises when people playing different games start influencing each other.
That's the key danger. A long-term investor starts seeing short-term traders making quick money and thinks, hey, maybe I should be doing that.
Even though their own goals are completely different, like saving for a house down payment in 5 years or for retirement in 30.
Or vice versa, maybe a trader gets influenced by long-term value arguments that don't fit their strategy.
Could be. The critical lesson is define your game. What are your specific goals? What's your time horizon? What's your tolerance for risk? And then this is crucial. Make sure your financial actions align with that, not with what someone else is doing who might have entirely different objectives and timeframes. Comparing yourself without understanding their game is just a recipe for confusion and bad decisions. Moving to a slightly broader perspective now, the book discusses something I found really fascinating. The seduction of pessimism.
Yes. It's such a paradox, isn't it? On average, and over the long haul, optimism is generally the best bet. The world tends to improve, people solve problems, innovation happens.
Things generally get better for most people over time.
Right. But pessimism often sounds smarter, more thoughtful, more cautious. It definitely gets more attention in the news and commentary.
And we should clarify, real optimism isn't just blind faith that everything will be great. That's complacency.
Exactly. It's more like what the statistician Hans Rosling called being a serious possibilist. It's believing the odds are generally in your favor over time, despite the inevitable setbacks, crises, and bumps along the road.
So why is pessimism so seductive then?
Well, the book suggests a few reasons. First, money is universal. Financial news impacts everyone, directly or indirectly. So discussions about market declines or economic worries feel very personal, even if you aren't heavily invested yourself.
Like that example about the Great Depression.
Exactly. The historian Eric Rauchway was quoted saying the initial crash only directly hit a small percentage of Americans, but millions who weren't invested watched the stock ticker crash and basically stopped spending, stopped economic activity, because they saw it as an index of their own future fate. Pessimism became contagious.
Okay, what else?
Second, pessimism often focuses on what seems unchanging or permanent. The risks, the flaws, the things that are hard. It sounds rational because it doesn't require imagining the world changing or people adapting and finding solutions. But of course, problems do incentivize solutions, and people are incredibly adaptable.
And the third reason?
Progress is usually slow. It compounds quietly, it's easy to overlook day to day. But setbacks, crises, they're often fast, sudden, dramatic, they grab all the headlines.
Like overnight tragedies versus slow improvements.
Precisely. We notice sudden losses, terrorist attacks, plane crashes, market crashes far more readily than the slow, compounding progress, like declining heart disease rates over decades, or the incredibly long, difficult process it took the Wright brothers to finally achieve flight. It applies to business, too. Failures can happen fast, success is usually a slow grind, and markets. Crashes are quick, gains are slow and steady over time.
This ties back really strongly to the power of narrative, the stories we tell ourselves.
Immensely. The book uses that great thought experiment. Imagine an alien visits Earth in, say, mid-2007, and then comes back in early 2009.
Okay.
Physically, very little would have changed. The buildings are still there, the roads, the factories, the technology is even a bit better. Yet the global economy had absolutely cratered. Millions unemployed, households, trillions poorer.
And the alien would be totally confused. Why?
Because the only significant thing that changed was invisible. It was the story people told themselves about the economy, about risk, about the future. In 2007, the narrative was one of stability, maybe a bit of froth, but basically sound. Prudence, markets pricing risk correctly, home prices always go up.
And in 2009.
That story completely broke. The narrative that home prices always rise collapsed. That triggered defaults, bank losses, fear, reduced lending, layoffs. A complete narrative-driven economic meltdown.
So stories are actually incredibly powerful economic forces.
Undeniably.
Okay.
And on a personal level, there are a couple of key things to take away from this. First, the more you desperately want something to be true, especially when the stakes are high and you feel like you lack control, the more likely you are to believe a story that overestimates the odds of that thing happening.
These are the appealing fictions the book talks about.
Exactly, like believing in investment schemes or managers that promise impossibly high, steady returns because you desperately want that security in an uncertain world.
Bernie Madoff comes to mind.
The classic example. The book points out his Ponzi scheme had red flags looking back. But millions of intelligent people invested because the story he told, consistent, high returns, exclusive access, was just so incredibly appealing. It fulfilled a deep desire.
Okay, and the second point about narrative for us personally.
Everyone operates with an incomplete view of the world. We all have blind spots based on our own limited experiences. But we need things to make sense. So we construct a complete narrative in our heads to fill in those gaps.
Often based just on what we've seen or what feels right to us.
Exactly. And that can lead to this dangerous overconfidence, making potentially disastrous financial decisions based on a story that feels complete and true to us, but is actually built on a very narrow, incomplete foundation.
Like following the herd into a bubble because the story everyone's telling makes sense based on recent experience, but ignores broader risks.
Precisely. Acknowledging how much you don't know and how much your understanding might just be a story you've constructed is really crucial for avoiding those kinds of traps.
Finally, the book wraps things up by tackling a really important distinction, I think. The difference between what is purely rational and what is reasonable.
Yes. This is a great way to frame a lot of the previous points. Academic finance, economics. They often focus on mathematically optimal strategies, what's perfectly rational on paper.
Maximize expected value, that sort of thing.
Right. But the book argues very persuasively, I think, that in the real world, with real emotions and real lives, people don't just want rational. They want strategies that maximize how well they sleep at night. They prioritize what feels reasonable to them.
So back to that rational Yale study suggesting young investors use massive leverage.
Mathematically optimal, perhaps, over an infinite time frame, but completely unreasonable because no actual human could emotionally withstand the potential for total ruin inherent in the strategy.
It wouldn't let you sleep at night.
Not a wink. A reasonable strategy builds in safety, that room for error, that margin of safety we talked about, to ensure survival and psychological comfort, even if it means potentially slightly lower returns on a spreadsheet. It prioritizes peace of mind over pure mathematical optimization.
This seems to explain that gap we sometimes see between the advice experts give and what they might do for themselves.
Exactly. Like mutual fund managers maybe not investing their own money in their own funds, or doctors choosing different, perhaps less aggressive end-of-life care for themselves than they might recommend for patients facing similar situations.
It's not necessarily hypocrisy, is it?
Not always. It just highlights that for these really complex emotional issues like managing your life savings or making huge healthcare decisions, there often isn't one single, universally right answer that applies to everyone. There's only what works for you, for your family, given your own unique circumstances, values, fears, and psychological makeup.
The author uses his own house ownership as an example, right? Owning it outright, no mortgage.
Yeah. He admits, mathematically, given historically low interest rates for years, keeping a mortgage and investing the difference would probably have been the best financial decision from a pure return on capital perspective. Rationally optimal, maybe. But for him, paying off the mortgage was the best money decision. Because the psychological independence, the freedom from that monthly payment, the sheer peace of mind knowing his home was truly his, no strings attached.
Yeah.
That was far more valuable to him than the potential extra basis points of return.
He prioritized psychological reasonableness over cold rationality.
Exactly. It's about optimizing for your own happiness, your own well-being, your own sleep at night factor, not just for maximizing the numbers on a page.
And that's a perfectly valid and arguably much more sustainable way to approach building a life that includes financial security but also feels good.
I think so. I recognize this we're humans, not calculators.
Wow. Okay, this deep dive into the psychology of money has given us so much to think about. Let's try to maybe pull together some of the key lessons from the book that really stood out.
Okay. First, maybe that less ego generally leads to more wealth. Remembering that wealth is often what you don't spend, the assets hidden away, which buy you freedom and options.
Yeah, manage your money in a way that helps you sleep well at night. Prioritize what feels reasonable and comfortable for you, maybe over what looks perfectly coldly rational on paper.
Understand that compounding is incredibly powerful, but super non-intuitive for our brains. Grasp its exponential nature, and then prioritize survival above all else so you actually stay in the game long enough for it to work its magic.
Be okay with things going wrong sometimes. In a world driven partly by tail events, those unlikely but highly impactful things, many ventures or investments will fail. That's actually a normal part of how things work.
Save money, even without a specific spending goal in mind. That unearmarked saving is your ultimate hedge against life's inevitable, unpredictable surprises, which always seem to pop up at the worst times.
Define the price of success, whether that price is dealing with market volatility, uncertainty, fear, and then be ready to pay it. View these not as fines to be avoided at all costs, but more like necessary fees for admission to potentially higher returns.
Worship room for error. Build in that margin of safety. It's not just being timid, it's what gives you the endurance to stay in the game, withstand shocks, and ultimately benefit from compounding and those positive surprises.
Avoid financial extremes. Why? Because you are going to change over time your goals, your desires, your circumstances. Extreme decisions made in the past can leave you feeling trapped or full of regret later on.
Be paranoid, maybe just a healthy paranoia, about ruinous risk. Anything that has the potential to wipe you out completely, preventing you from getting back up and taking future productive risks. Protect against that downside above all else.
And define your game. Really know your personal goals, your time horizon, your risk tolerance, and don't get swayed or discouraged by comparing yourself to other people who are playing a completely different game with different rules and objectives.
And maybe finally, just respect the mess. Acknowledge that money behavior is incredibly complex. It's driven by this whole tangle of emotions, personal histories, psychological biases, powerful narratives, not just by neat logic and simple math.
Yeah. Ultimately, this deep dive into the book really reminds us that while the math of money can sometimes be simple, the human side of it is anything but. Understanding the psychology behind our decisions, acknowledging the powerful role of our unique experiences, respecting luck and risk, these seem fundamental to navigating money effectively and building a life that feels right for you.
Absolutely. So maybe here's a thought to leave you with. How much of your current approach to money is driven by trying to perfectly optimize the numbers, achieve what looks totally rational on a spreadsheet, versus how much is driven by prioritizing what feels truly reasonable to you, what helps you feel secure and sleep well at night?
How might shifting that balance even slightly change your financial decisions and maybe your overall peace of mind?
Or perhaps, think about how much of your financial worldview, the stories you tell yourself about money, is shaped by your own specific limited experiences, or maybe narratives you've just inherited. Are those stories still serving you well today? Or could they possibly be leading you down a path that doesn't truly align with who you are now or who you want to become?
Definitely something worth mulling over.